Hello, and welcome to this ERI Scientific Beta webinar presented by Felix Goltz, Research Director with Scientific Beta. Today's webinar focuses on long-term rewarded equity factors. We're going to look at what investors can learn from academic research. We have some materials for you to follow, which will help outline key points. And now if we move on to this first slide, we can see the importance of academic grounding, heavily highlighted by a range of index providers. So here are a few examples. Firstly, MSCI. MSCI states that it currently identifies 6 equity risk premium factors which are grounded in academic research. For Russell indexes, they say in developing the Russell High Efficiency Factor Index series, we ensured that our factor specifications were consistent with academic research findings. Another example is FTSE. The FTSE Global Factor Index series is designed to represent factor characteristics for which there is a broad academic consensus. And finally, our own ERI Scientific Beta states that factor indices are meant to be investable proxies for rewarded factors that have been analyzed in the academic literature. Okay, Felix, so it seems that much emphasis has been placed on academic research. What lessons can we draw from this?
Yeah, so there's literally hundreds of academic papers, and it's still a very active area in academic research. So there's a huge amount of papers looking at understanding which are the relevant factors, and it's interesting to look at this literature. Again, it's there's a huge volume, and so you can try to distill some important lessons out of this research. And if you look at the entire body of research, I think there's basically 3 important lessons which we noted down here. And basically the first lesson is really about how to draw conclusions from the data. So empirical research has looked very closely at factors. What are the rewarded factors? How robust are these factors? And so a first important conclusion is really how do we actually work with data. Academic research does very serious analysis of the data, and this is the first area where important lessons can be drawn from looking at academic research. So how do actually academics go about getting conclusions from analyzing the data? What are kind of the quality standards, and how do we make sure that the conclusions are actually reliable? So being very serious with data analysis is a first important lesson out of this body of research. Secondly, so when you analyze data, obviously, you're going to come up with conclusions, but ultimately, these conclusions are not very relevant if you don't have a good explanation also of, why do you actually find certain effects in the data. So what's important is not just looking at empirical results, but also looking at theory. Okay, so why should these effects be there in the first place? And again, this is an area where academic research on factor investing, has made considerable progress, and there's lots of different explanations for these phenomena. Thirdly, and I think this is a very interesting point, well, if you have strong empirical evidence and you have a theory for why a given set of factors should be relevant, well, how about practice? So in the end, from a perspective of factor investing, are these factors implementable? Are they investable? How do you actually go about assessing these issues? So this is perhaps surprising, but in this area, actually, academic research has a lot to say. So there's lots of analysis also of the practical aspects. So are these things actually implementable? So these are the 3 main areas in which we can draw lessons.
Okay. Now, on this issue of back tests and data analysis, what are the lessons to be learned in that respect?
Yes, so in terms of empirical analysis, I think what is important to recognize, first of all, is that we're dealing with a very difficult question. So it's actually very difficult to get reliable insights into expected returns. And if you think about factors, what does it mean that there is a reward to a given factor? Essentially, it means that you actually are able to determine differences in expected returns across different types of stocks. Okay, so you're talking about differences in expected returns, which you tie to exposures to factors. But we know that when you try to estimate expected returns, well, this is a very difficult problem. So there's a famous paper by Merton in 1980 where he talks about expected return estimation. Well, what's the problem here? The problem is simply that when you think about expected returns, you're very reliant on actually few data points, because an observed average long-term return will depend essentially on the starting price and the end price of an investment. So it's actually very difficult to get reliable insights into expected return. So given this difficulty, empirical research into factors has actually come up with very thorough analysis. So research typically looks at very long-term data. So that's the first way of getting more reliable conclusions. It also looks at a factor across different data sets. So if you find one thing in a sample, it's not necessarily going to be reliable. So there's lots of cross-sample analysis. People look at different types of data sets to assess whether a finding is robust. And finally, academic research also tests for multiple testing. So there's papers that introduce methods to actually account for the fact that, well, there could have been a lot of data mining, because lots of researchers, look through the same data and could come up with effects, which in the end are just spurious and are not going to be reliable. So there's very thorough analysis, which, we're going to go into some details. But overall, what is important about empirical research, empirical academic research, is that, these studies are open to criticism. So there's a first bar, if you will, which is publishing research results in a peer-reviewed academic journal. Of course, comes with certain quality standards. Okay, so only the best and kind of most rigorous findings are actually accepted to be published in the top journals. But secondly, even if a paper is published, it's open to criticism. Okay, so the general data that people use is very widely available. And academic researchers can question and criticize existing academic research, and so there's lots of room to actually come up with a debate that ultimately leads to a consensus. So having a finding that is published in one paper is one thing, but actually having a finding which is assessed extensively and is then being confirmed independently and kind of validated externally by additional research will ultimately be much stronger and will be a stronger indication that the findings are actually reliable. So if you think about empirical research in finance today, if you think about the main US database for equity returns, the CRISP database published by the University of Chicago, well, there's roughly 500 academic institutions that actually subscribe to that data. They all have access to this data. So if someone publishes a new finding, there's obviously competition, and basically researchers in 500 other institutions can actually check whether they agree with these findings. So ultimately, whatever consensus you come up with, is something that will be quite reliable. And what this means is that a factor that has been validated by academic research, it's not just something that comes out of a backtest. Like sometimes you have backtests from product providers, so they can run backtests. That's fine. But actually, academic findings, they're not just specific to one paper or one provider. The consensual factors, at least, have gone through a whole, validation process, and at each point in time, people can actually question the results.
Okay.
That's very important.
So there's a consensus across academia, as it were. Okay. And what are the results of such empirical analysis?
Yeah. So the results are quite interesting. So I'll just illustrate some of the results.
Okay.
So first of all, what's very important when people do serious analysis, serious empirical analysis, is obviously this aspect of a very long-term analysis. So you can always find sample-specific, results and patterns by looking at, say, 10, 20 years of data. So if you think about analyzing data on US stocks, this is really the area where we have access to high-quality long-term data, and I just provided an illustration here, just citing a few kind of recent papers of what are actually the typical time periods that are covered in this research. And you will see that actually, most of this research looks at time periods of something like 90 years, 50 years. So clearly this is, these are much longer periods than you would find in typical, product backtests. And obviously any finding that holds on average over 90 years, is less likely to be just sample specific or time period specific. So basically a lot of the factors, and you have a list here of the 6 main factors, a lot of these factors actually are based on evidence for US equities, which actually goes back about 90 years. That's the starting date of the data in the CRISP database. So for things like momentum, low risk, size, we do have analysis over almost a century, okay, looking at these effects, which ultimately is kind of a very strong long-term assessment. When it comes to factors that actually use accounting data, so say the value factor, the profitability factor, and similar factors, research typically looks at about 50 years of data. So the explanation is simply that high quality data on accounting variables is available for about the past 50 years for the US. But again, here you can see that the evidence on the main factors is really very long-term evidence over many decades and sometimes close to a century. So that's for the US data. But obviously, if you find something over 90 years in US data, it may still be specific to, say, the US stock market. And so what's interesting is to go to different types of data sets, different types of samples. And this is where, again, academic research has looked very extensively at the main factors. So I listed here just an overview of studies that have assessed the 6 main factors, not just in US equities, but also in international equities, and even in other asset classes. So this is just an overview, but starting with the early studies, quite often in the 70s and the 80s, that were on US equities. Researchers have then extended this analysis to international equities, developed market equities, particular regions, in many cases even emerging market equities. And the same factors that had been shown to be at work in US equities have actually been confirmed across different data sets. What's very interesting is that researchers have even gone beyond simply equity markets and have looked at analyzing whether the same factors are also at work in completely different markets in different asset classes. So in fixed income, currencies and commodities, also referred to as FCC, we find some of the same factors are actually at work. So there's recent papers showing that, for example, value, momentum, and low risk are also at work in commodity futures markets, for example, in currencies markets. And obviously, that suggests that these factors are much more reliable, because if they just happen to work, say, in the US equity data for just by chance, well, it's very unlikely we would also find them at work in something quite independent like commodities market. So ultimately, this suggests that the evidence is quite strong. Mm-hmm. And a final issue that academic research looks at is so-called multiple testing. Okay, so we said as well, there's lots of research institutions, lots of researchers look through this data, and the problem with that is that the usual criteria for deciding whether a factor is significant or not, they basically don't apply. So the usual criteria assume basically that there's a single test. You start with a hypothesis and then you test whether that single factor is actually significant or not. Now, in practice, obviously, people may test, lots of factors. There's lots of data available and lots of computing power to test these factors. So you can run many tests. And the problem with that is that the usual levels of threshold to assess significance don't apply anymore. And here, academics have come up with alternative assessments and alternative ways of setting the thresholds. These are quite recent papers, but what they suggest is that especially for the main factors, a lot of the main consensual factors like, say, value and momentum and other main factors, the results are actually robust even to raising the bar for significance. And even if you accept that probably many different variables have been tested over time, even if you adjust for that effect, the main factors are still significant. So there's really very thorough analysis of long-term data, cross-sample validation, and adjustment for multiple testing, which mean that any evidence that survives all the scrutiny is actually quite strong evidence that a given factor plays a role.
Okay, so in summary of the first lesson that you evoked, we have to be serious with the data. But I'm going to go back. You mentioned previously that it's not enough to just be serious with data. Like, must go beyond being serious with the data. So why is it important to do that? Why is it important to take it one step further.
Yeah. So why is it important to look beyond data? Well, simply, finding an effect in the data. Ultimately, if you have no fundamental explanation for why that effect should exist, is obviously quite limited, because the important question obviously is not just whether you find an effect in the data, but the important effect is really, is that effect going to be persistent, right? Okay. And that's something that you can't assess given the data. The data only tells you about the past, and so even if that analysis is very serious and thorough, ultimately you're interested in, should there be any reason in the first place why this premium should exist? And if there's a good theoretical reason, then you could expect that such a premium could be persistent. So there's actually quite a kind of strong argument used in lots of academic research, basically putting the emphasis kind of away from analyzing the data and putting it on actually analyzing the underlying economic mechanisms. Okay, so what are actually the economic reasons for why a given premium should exist? And why is this important? Well, you can make a kind of simple explanation by looking at the equity risk premium. So the equity risk premium, basically says that investors should be rewarded in the long term for holding equities as opposed to holding bonds, for example, that are much less risky. And if you look at the data, you can obviously try to come up with an estimate of that equity risk premium. But it turns out that actually from an empirical perspective, it's very difficult to actually decide what kind of the right amount should be for the equity risk premium. So basically the confidence bounds are so wide around the point estimate that you get, because there's lots of uncertainty in the equity risk premium. Returns are fluctuate widely over time. And so ultimately, if you want to form an opinion about the equity risk premium, should it exist, should it be positive, what should be the magnitude, you need to go beyond the data, and you need to think about the reasons why that premium should exist. And in the case of the equity risk premium, economic reasoning will tell us that, since equity investments are more risky than bond investments, investors will want to be rewarded for holding that risk, right? So even if analyzing a particular data set tells us that, equity returns were actually negative compared to bond returns over that period, we're not likely to, make too much of that finding. But we'll think it's maybe sample specific because, theory tells us that it should be different, right? So when you go away from this general equity risk premium, you think about other factors. Actually, you can use kind of very similar analysis, and it'll be similarly useful.
Okay, great. But so what are the main economic mechanisms then behind the factor premia?
Yeah, so the economic mechanisms are actually quite similar in a way to, say, the equity risk premium. So I just provide here an overview of the different explanations for why the 6 main factors should actually lead to a reward in the long term. And kind of this is a very rough summary, so there's lots of explanations for why these factors should matter, sometimes competing explanations, but what is important to note is that we do have kind of a wide range of explanations of why these factors should be there in the first place. Okay, so independent of whether we find them in the data, there are good reasons to believe that things like value, momentum, low risk, size, and additional factors should actually lead to a reward. And there's basically 2 competing explanations. One is a risk-based explanation, so similar to the finding of the equity risk premium. If getting exposure to these factors exposes investors to additional type of risk, then they would expect to be rewarded for taking on that additional risk in the long term. And indeed, there's lots of kind of detailed theories and detailed findings that some of these factors lead investors to take on additional types of risk. So this is so-called risk-based explanation. The interesting feature of a risk-based explanation is that it gives a reason for persistence, right? So if tilting towards momentum and value and other factors exposes investors to additional types of risks, then there's no reason why these premiums should disappear. A different explanation is a so-called behavioral explanation. So if investors suffer from behavioral biases and they're actually going to make errors, that will actually lead to value stocks, for example, having a lower price than they should have if investors were perfectly rational, well, then some rational investors who understand this kind of anomaly and this irrational behavior of others will actually be able to exploit this anomaly. But ultimately, if investors exploit this kind of anomaly, then the premium should disappear in the long term. So behavioral explanations actually don't make the case for a persistent premium. The additional element that is needed with behavioral explanations is so-called limits to arbitrage. Okay, so if investors make errors, and if rational arbitrageurs cannot correct these errors because there's frictions on markets, there's constraints to short selling, for example, there's leverage constraints and so forth, then even these purely behavioral effects could actually persist in the long run. So you can assess which types of explanations actually make sense for the different factors. And just to give you kind of some examples for risk-based explanations, so if you take momentum stocks, for example, the momentum premium has been explained by the fact that momentum stocks actually tend to be high expected growth stocks. So that means when there's a shock to expected growth in the economy, momentum stocks are actually more concerned by that kind of shock. Okay, and so in that sense they're more risky. Okay, they may not have higher volatility on average than the average stock market, but in certain types of market conditions, that typically are bad times for investors, they may actually lead to pronounced underperformance, and so investors want to be rewarded for taking on that type of risk. So there's kind of very kind of considerable important theoretic explanations in addition to the empirical evidence.
Okay. Well, you mentioned the word theoretic there. So far it's been very theoretical in terms of the explanation, but can you expand more on the practical implementation side of things? Isn't this where academic research becomes a bit too theoretical or unrealistic? Yeah.
Yeah. So this is obviously an important concern, and indeed, if you look at academic research, well, a lot of the early research on factors, was basically completely ignoring implementation concerns like transaction costs, for example. Okay, so people also refer to this as paper portfolios. So yes, you can show that on papers, following a momentum strategy or following other types of factor-based strategies actually leads to a reward. But how about practice? I mean, clearly, tilting to a factor typically generates turnover. You have to dynamically kind of reshuffle the portfolio, and so do the premia that are shown in academic papers, do they actually survive transaction costs? So that's kind of a very relevant question. I think what's perhaps surprising is that actually academic research has devoted considerable effort to figuring out these questions, and so there's actually a fairly large amount of papers that do try to see whether after transaction costs these kind of factors actually still deliver the premium. And obviously it's an important question. So I mentioned previously, empirical research findings are scrutinized. Okay, so there's lots of external scrutiny from other researchers. There's competition of ideas. So one way to scrutinize a research finding is basically to see whether it actually survives transaction costs, right? And so you can show whether or not a published factor is just an illusion or whether it's actually implementable in practice. And this is where academic research has come up with assessments. So net of transaction costs, do these factors still deliver premia? But academic research has also looked at simple ways of actually mitigating potential issues with implementation. So without deviating from the standard factors, research has shown that you can actually have implementations that will, for example, have much lower turnover than if you look at these factors with disregard to implementation. So I think this is quite important because providers sometimes make the case for proprietary factors and kind of proprietary enhancements because they say, well, these academic factors, they're nice in theory, but we can't use them because we have to implement them. But if you look at the literature closely, it's actually clear that the standard factors can be implemented and without suffering from transaction costs that would actually cancel the returns.
Okay, and staying on with transaction costs, what are the findings of transaction costs for factor investing then?
Yeah, so I mean, this is where, again, there's lots of papers in this area.
Mm-hmm.
So there's debate. So there's different findings, from different authors. So I'll just try to give an insight, looking at some of the recent papers here in this area. And I'll just show you, as an illustration, an example of what happens when you actually calculate kind of realistic net returns after transaction costs, to the standard academic factors. So this is a table, and the results are extracted from a recent paper by Novimax and Velikov, so just published earlier this year in the Review of Financial Studies. And what they look at really is, net of costs, what are actually the factor premiums? So they have lots of results for different factors. Here you just have a summary, just looking at the 6 main factors, and you see that what they do is they look at the gross premium, and then they look at the net premium. So they come up with a measurement of the transaction cost that investors would bear by actually tracking these academic factors, and then they come up with an estimate of the net premium. And what you can see is that typically the net premium is still positive and significant. If you look at momentum, for example, momentum is a very good example. It's typically argued that momentum is quite hard to implement. Momentum leads to lots of turnover. So there's often a debate whether momentum is actually worthwhile pursuing because of the high turnover. Well, what they show is actually that momentum has a very kind of sizable premium, 1.33%, if you disregard transaction costs. So this is a monthly premium. Okay, so this is indeed quite a sizable premium, 133 basis points monthly. Now the turnover is also huge, 34%. Monthly turnover. This leads to fairly high transaction costs, but even net of these relatively high transaction costs, they show that you get a monthly premium of 68 basis points, which is still statistically significant. And so what this shows is that even if you don't take care of good implementation, okay, you just naively apply these academic factors, in many cases the net premium is actually still positive and significant.
Okay. So slight manipulations to implementation lead to even better net results, as it were.
Yes.
Okay,
indeed. Yeah.
great. Well, we're nearly out of time, so can you just summarize the main takeaways? What can investors do better when it comes to academic research?
Okay. So, this is an interesting question. What can investors do better? What can providers do better? And I think what you see today when you look at the area of smart beta and factor investing, this starts with a very nice idea. Okay, one of the starting points of factor investing was the report that Professors Ang and Schäfer and Götzmann wrote for the Norwegian sovereign fund, where basically they argued, well, let's look at these academic factors, because actually a lot of the returns that you get from active managers, well, they're just, you can replicate them with these academic factors. And the starting point really behind this whole, trend towards factor investing was really to use these academic factors because they're well documented. And, that means that ultimately, we're making investment decisions really based on the evidence. And there's, as we've discussed, there's quite a kind of firm basis with actually lots of evidence concerning the standard factors. Now, what we see in practice is that sometimes, this academic grounding behind factor products, is really more like a lip service. So, it's, probably useful, for marketing reasons to say that, we have an academic grounding. But when you look at the actual, implementation and how things are actually done, probably some of the lessons we discussed are not really taken seriously enough. So just on the first point, being serious with the data. What we see in practice is, quite common that strategies are based on, more or less ad hoc picking of variables. So strategies are being based on quite exotic and proprietary definitions, where ultimately, that is not consistent with the factors that we know from the academic literature. And also some of these backtests, quite typically are based on 10 to 15 years of data. So again, that's not something that is close to kind of the high standards in academic research, where we look at, very long-term evidence. So, backtests shouldn't be based on 10 to 15 years of data. Also in terms of the economic rationale, a lot of the academic factors have quite a sound economic rationale. So ultimately, if you think about, designing a factor, you shouldn't just look at the data and see whether that factor has great returns in a back test, but ultimately, why should it have high returns? What's actually the reason for that? And here again, in practice, we actually see a lot of anecdotes. Okay, so people come up with kind of stories, saying that some of the factors should work, but they're not really based on a formal theory. So if you look at some of the kind of quality-based factors, for example, that people use, well, sometimes you find arguments, well, this is kind of like, you invest like Warren Buffett into very, stable earnings companies or similar kind of factors. But, that's not a strong economic rationale, that's just an anecdote. And if you don't have a formal theory, of why a factor should work, well, then, maybe that factor is not as reliable as one where you do have that strong theory. And finally, I think, the most obvious lesson and where people can actually do a lot better is on transaction costs. So this is, I think, what's really surprising that, product providers quite often do not account for transaction costs. And, obviously it's difficult to do. And, you can argue that, well, we don't show any analytics on transaction costs because, it's difficult to do. But, in the academic literature, you actually do have methodologies that allow estimating transaction costs. You do have some evidence on what transaction costs are. So ultimately, product providers should also report what kind of reasonable levels of transaction costs they would expect from implementing their strategy. So overall, academic grounding shouldn't just be, some kind of lip service or a marketing speech, but it should actually really go into how products are designed, and the insights of academic research should also go into how investors actually assess these strategies and do their due diligence based on the academic evidence.
Okay, great. Well, that's all the time we have for today. Thank you for sharing those insights, Felix. To our viewers, thank you for watching, and we hope you have found this discussion informative. We have recently published a white paper on this topic, which goes by the same name as this webinar, Long-Term Rewarded Equity Factors: What Can Investors Learn from Academic Research? We will be sending out the link to replay this webinar and to download the related white paper. As always, if you do have any questions regarding the topic just covered, please send them to us via email at webinar@scientificbeta.com. We will be sure to respond to you as soon as we can. Lastly, if you do not already do so, please follow us on social media. We are on LinkedIn, and our Twitter handle is @scientificbeta. Thank you for watching today, and goodbye.